First, video killed the radio star. Then, Netflix killed Blockbuster. Now, that same relentless force of technological disruption is coming for an institution that stood for centuries, an institution that holds your money, your security, and your future. It's coming for your bank. That solid, dependable building on the corner is on a path to becoming a museum piece. By the end of this decade, the very idea of a traditional bank might feel as outdated as a horse and carriage, and most people aren't ready for what's next. This isn't some far off prediction. It's a shift happening right now, just beneath the surface of our everyday lives. It's a quiet revolution, but its impact will be deafening. The institution that's been the bedrock of commerce and the trusted steward of our savings is facing an extinction level event. It's not being driven by a single force, but by a pincer movement of two powerful technologies that are fundamentally rewriting the rules of finance. In this video, we're going to pull back the curtain on this monumental shift. We'll break down the two forces, the relentless takeover of digital wallets and the endgame of stablecoins, that are quietly but systematically making your bank disappear. We'll explore the visible signs, the invisible cracks in the system, and what this financial earthquake means for you. Because the question is no longer if this will happen, but how you'll position yourself when it does. The end of banking doesn't start with a bang. It starts with a slow, creeping silence. A locked door, a papered over window, and a sign that reads, "This branch is now permanently closed." This is the most visible crack in the foundation of traditional banking, and it's happening at a staggering pace. In just the first 3 months of 2025, more than 320 US bank branches were already marked for closure. That's hundreds of communities losing a physical connection to the financial system. This isn't a new trend, but it is dramatically accelerating. The COVID-19 pandemic was a massive catalyst, forcing a rapid shift to digital and proving what banks already suspected. Maintaining vast, expensive networks of physical buildings is a drain on resources. The big players are leading the retreat. In the first quarter of 2025, US Bancorp and Wells Fargo were the most active, closing a combined 73 net branches. Big names like JP Morgan Chase and Bank of America are also steadily shrinking their physical footprints. In Europe, the story is much the same, with thousands of branches closing as banks chase cost efficiency. These aren't just empty buildings, they represent a fundamental retreat from the physical world. Banks publicly say it's because customers are moving to digital platforms, and they're not wrong. In 2025, a large majority of US adults are using digital banking services. Foot traffic in branches is in a nosedive. In late 2024, only 45% of US bank account holders reported visiting a branch in person, a steep drop from just a few years prior. But the branch closures are just the symptom. The disease runs much deeper. It's in the invisible cracks of the system, the outdated, clunky, and infuriatingly slow technology that underpins the entire traditional banking world. Think about the last time you sent a wire transfer. It feels like a process designed in the 1970s because, well, it mostly was. You fill out a form with arcane details like SWIFT codes, pay a hefty fee, often $25 to $50, and then you wait. A cross border transfer can take 2 to 5 business days to settle, creeping through a tangled web of correspondent banks, each taking a slice and adding delays. Even domestic transfers like the ACH system in the US are shockingly slow. When your employer sends your paycheck, it doesn't arrive instantly. It travels through a batch processing system that can take 1 to 3 business days. In an age where we can stream a 4K movie to a device in our pocket from the other side of the world, our money still travels at the speed of a horse-drawn carriage. This isn't just an inconvenience, it's a colossal inefficiency. The global payments industry is a multi-trillion-dollar behemoth, yet it operates on rails that are fundamentally broken. They're slow, expensive, and exclusionary. This friction is everywhere. It's the 3 to 5 day hold on a deposited check. It's the simple fact that the entire system shuts down on weekends and holidays, as if the global economy operates on a 9 to 5, Monday to Friday schedule. We've been conditioned to accept this. We've been taught that this is just how money works. But a new generation of technology is exposing this as an artificial constraint. The contrast is stark. While your bank takes days to move your money, an app on your phone can do it in seconds. The physical branches are disappearing because their model is obsolete. The invisible infrastructure is cracking because it was built for a world that no longer exists. The closure of a bank branch might seem like a minor inconvenience. For many, it just means you drive a little further, or more likely, use the mobile app you were already using. But this view misses a much darker consequence: the spread of banking deserts. A banking desert is a neighborhood with no physical bank branches within a reasonable distance. As branches vanish, these deserts are spreading. Between 2019 and 2023, the number of Americans living in a banking desert grew by 760,000, bringing the total to a staggering 12.3 million people. This trend disproportionately harms the most vulnerable. Rural areas are hit hard, as are lower income communities, older adults, and people without reliable internet. For them, digital banking isn't a convenient alternative, it's an inaccessible one. When the last bank in a small town closes, it rips a hole in the community's fabric. Local businesses struggle to get cash for daily operations. Residents are forced to travel miles just to cash a check or speak to a person about a loan. Research shows this drives people toward predatory alternatives like check cashing services and payday lenders, which charge exorbitant fees and trap people in cycles of debt. The impact is generational. A study found that people who grow up in banking deserts develop worse financial literacy and end up with lower credit scores, a disadvantage that follows them for life. But even if you don't live in a banking desert, this systemic decay affects you. It's a loss of control. Your access to your money is mediated by a slow, inefficient system. The few dollars skimmed from a wire transfer, the percentage points from a currency exchange, the interest spread between what they pay on your savings and what they earn by lending it out. This is their lifeblood. The traditional banking system is a series of toll booths on an old highway. Every transaction is an opportunity to extract a fee. This isn't a partnership, it's a parasitic relationship. They hold your money and give you an interest rate that is often dwarfed by inflation, meaning your savings are actively losing purchasing power. They use your deposits to generate massive profits for themselves, lending it out at much higher rates. You, the depositor, take on the risk while the bank reaps the rewards. And what happens when this outdated system is stressed? We saw the answer in 2023 with the collapse of institutions like Silicon Valley Bank. It exposed the inherent fragility of a system where banks can be brought to their knees by a sudden loss of confidence. Those events were a stark reminder that the money you think is safe in your account is part of a complex, leveraged machine, a machine that can and does break. This is the agitation. It's the realization that the system we've trusted is not only failing the most vulnerable, but is also failing all of us. It's eroding our wealth through inefficiency and holding our financial lives hostage. Your money is trapped in a dying system. But as the old world crumbles, a new one is being built. And the first phase of this revolution is already in your pocket. The first wave of the tsunami that will ultimately wash away traditional banking didn't look like a revolution. It looked like an app. It started with services like PayPal and then exploded with Apple Pay, Google Pay, and Cash App. These are the digital wallets, and they've been systematically dismantling the bank one function at a time. For decades, the bank was a bundled service. It was the only place to store money, send money, get a loan, or invest. Digital wallets have unbundled the bank. They started with the simplest and most painful function, peer-to-peer payments. Remember splitting a dinner bill with cash? Digital wallets made that friction disappear. With a few taps, you could send money instantly to a friend for free. This trained a generation to expect financial interactions to be instant, seamless, and free, the exact opposite of the traditional banking experience. From there, the takeover accelerated. These platforms wanted to become your entire financial hub. They began adding services that were once the exclusive domain of banks, savings. Digital wallets now offer savings accounts, often with higher interest rates than brick and mortar banks. Getting paid. They moved from a way to pay friends to a way to get paid by your employer, bypassing the need for a traditional checking account. Spending. With physical and virtual debit cards, digital wallets became a full replacement for a bank debit card. In 2024, they were already used in 32% of in-store transactions globally, more than any other single payment type. Investing, apps like Cash App and PayPal integrated stock and crypto purchasing, democratizing access to investments. Borrowing. Buy now, pay later (BNPL) services, often built into digital wallets, have emerged as a massive competitor to bank credit cards. This unbundling has been wildly successful because it attacks the bank's core weakness, their terrible user experience. Banks are product-centric. Digital wallets are customer-centric. They solve problems. The numbers tell a story of a seismic shift. The global digital wallet user base is over 4.5 billion in 2025 and growing. The transaction value flowing through them in 2024 was around $10 trillion. They are expected to account for over half of all global e-commerce transaction value this year. In the US, about two-thirds of adults use a digital wallet, and for younger generations, that number is even higher. This is the first phase of the bank's disappearance. The bank is becoming a dumb utility in the background, a place a paycheck might land before it's immediately swept into a digital wallet where it's actually used. This phenomenon is called embedded finance, weaving financial services directly into the apps we use every day. Your bank is no longer the center of your financial universe. For many, that center is now Apple, Google, or PayPal. Traditional banks are now in a fight for relevance. Some are trying to compete by improving their apps, but they're playing catch up. Others are partnering with fintech disruptors, offering banking as a service, one BaaS, where they provide the regulated plumbing that powers the slick app on the front end. In this model, the bank becomes an invisible utility, ceding the customer relationship to the tech company. The digital wallet has pried open the bank's clenched fist. It has shown the world there is a better, faster, and cheaper way. But this is only the beginning. Digital wallets have weakened the banks, but the next phase is poised to deliver the killing blow. If digital wallets were the battering ram that broke down the bank's front door, stablecoins are the army about to render the fortress obsolete. This is the endgame. This technology doesn't just offer a better interface for the old system, it replaces the system's foundation. So, what is a stablecoin? Let's demystify it. Imagine a dollar that has a digital twin. This twin lives on the internet, on a public network called a blockchain. You can hold it in a digital wallet and send it to anyone, anywhere, anytime without needing a bank. It combines the stability of the dollar, its value is pegged one to one, with the speed and global nature of cryptocurrency. This is the final nail in the coffin for traditional banking because it makes the bank's core infrastructure redundant. Remember those slow, expensive wire transfers? That entire mess of correspondent banks and clearinghouses is built to solve one problem: moving value from point A to point B. Stablecoins solve this in a fundamentally superior way. Instead of a multi day journey, a stablecoin transaction is a direct transfer from one digital wallet to another. The final settlement happens in seconds or minutes. The cost? Instead of $50, we're talking about fractions of a penny. The scale of this new system is already mind boggling. In 2024, the annual transaction volume settled using stablecoins reached a staggering $15 trillion, a figure that rivals the volume of Visa. This isn't a niche experiment, it's a parallel financial system operating at a global scale. The stablecoin market cap soared to a record high of over $300 billion in late 2025. Why is this so powerful? Because it rips out the heart of the banking business model. Banks make money by being the necessary friction in the system. They're the gatekeepers. Stablecoins operate on open networks. There are no gates. Consider the impact on businesses. A major retailer can pay billions in credit card fees annually, typically 1.5% to 3% per transaction. With stablecoin payments, these costs could plummet. The economic incentive is simply too massive to ignore. For cross border commerce, the change is even more profound. A small business paying a supplier overseas can do it as simply as sending an email, direct, almost free, and settling in minutes. This levels the playing field and unlocks global trade. This isn't just about payments. Stablecoins are the foundation for a whole new ecosystem called decentralized finance, or DEFI. Because stablecoins are programmable, developers can build applications that replicate and improve upon traditional financial services, all without a bank. You can deposit your stablecoins into a decentralized lending protocol and earn interest, often at significantly higher rates than a savings account because you're cutting out the middleman. This is the stablecoin endgame. A world where a bank's primary functions, holding deposits, processing payments, facilitating lending, are all performed more efficiently and cheaply on open networks. The transition is already underway. A growing number of financial institutions are now using stablecoins in some capacity. Major regulatory developments, like the Genius Act in the US, are providing clearer rules, which will only accelerate their adoption. The bank's monopoly on money is over. For centuries, they controlled the ledger. The new ledger is the blockchain, public, open, and accessible to anyone. What does a world without traditional banks actually look like? It's not a dystopian future, but one of radical efficiency and empowerment. Let's paint a picture. It's Friday morning. Your paycheck doesn't deposit into a bank. Instead, it lands instantly in your digital wallet as a stream of stable coins, digital dollars that you control. There's no 1 to 3 day delay. The moment your employer sends it, it's yours. A portion of your income is automatically routed into different vaults. One for spending, another sweeping into a decentralized lending protocol. Here, instead of earning a negligible interest rate, your digital dollars are earning a dynamic yield of 5%, 7%, or even more, a rate that actually outpaces inflation. You are no longer just a depositor, you are your own bank, earning the yield that traditional banks use to keep for themselves. You head out for coffee and pay by tapping your phone. The transaction settles instantly between your wallet and the shops. There's no card network taking a 2 to 3% cut. The merchant gets the full value in seconds. Later, you send $200 to family overseas. You open your wallet, hit send, and the stablecoins arrive in under a minute. The cost, a few cents. This new financial world is also about intelligence. Your digital wallet evolves from a simple container for money into an AI powered financial advisor. It analyzes your spending, helps you budget, and models payment scenarios for large purchases. This AI can constantly scan thousands of DEFI protocols to find the best possible yield for your savings, automatically moving your funds to capture the highest returns based on your risk tolerance. The entire model shifts from being product centric to being entirely customer centric. This new world also fosters unprecedented financial inclusion. The billions of adults globally who are unbanked often lack the documentation or minimum deposit to open a traditional account. In the stablecoin world, all you need is a basic smartphone and an internet connection. A digital wallet can be created in seconds for free, giving anyone immediate access to a global financial system. A farmer in a remote village can receive payments from international buyers just as easily as a corporation in New York City, a trend already surging in markets across Africa and Southeast Asia. Capital becomes more fluid, transaction costs are dramatically reduced, and individuals regain sovereignty over their assets. Of course, this vision isn't without its challenges. The transition will be complex, and it's crucial to have a clear eyed view of the path forward. A transition this monumental is never a straight line. To claim the world will seamlessly shift to a decentralized economy would be naive. The three biggest hurdles are regulation, security, and trust. First, regulation. Governments aren't going to sit idly by. The regulatory environment in 2025 is a complex patchwork. In the US, for instance, new legislation like the Genius Act aims to provide a clear framework for stablecoins, which is a massive step forward. However, regulators are also intensely focused on new risks, cybersecurity, financial crime, and ensuring these platforms can withstand shocks. Navigating this evolving web of rules is a major challenge. The second hurdle is security. While blockchain technology is secure, the apps built on top of it aren't infallible. We've seen billions lost in DeFi hacks. The mantra of be your own bank comes with a high degree of personal responsibility. In the traditional world, you have protections like FDIC insurance. In the decentralized world, if your private keys are stolen, your funds can be gone forever. For mass adoption, security needs to become virtually foolproof, abstracting away the complexity for the average user. Finally, there's trust. Banks have had centuries to build their reputation. The crypto world, by contrast, is still viewed with suspicion by many. The collapse of algorithmic stablecoins like Terra/Luna left a deep scar. True, fully backed stablecoins are a much safer model, but earning public trust requires radical transparency, verifiable audits of the reserves, and time. Incumbents like Visa and MasterCard won't go down without a fight either. They argue that consumers value the rewards and fraud protection that come with credit cards, a brand trust that will be difficult to dislodge. These hurdles are significant, but they aren't insurmountable. They are the engineering challenges and policy debates that happen in any major technological revolution. The economic incentives are so powerful that immense resources are being poured into solving these very problems. So, will the bank as an institution vanish entirely? Probably not. But the bank of the future will be almost unrecognizable. It won't disappear, but it will be forced into a radical and perhaps diminished new role. The survivors will be those that stop fighting the future and find their place within it. Many banks will transition from being a consumer brand to being the invisible, regulated plumbing that supports the new financial ecosystem. This is the banking as a service model. In this future, a tech company like Apple designs the customer experience, but in the background, a licensed bank provides the regulated infrastructure. They'll hold the dollars that back the stablecoins, offer the FDIC insured accounts linked to wallets, and check all the regulatory boxes. They become a utility, essential but invisible. For the banks that choose this path, it's a survival strategy. It allows them to leverage their core assets, their charter and compliance expertise to find new revenue. However, this isn't an easy path. Regulatory scrutiny on these boss partnerships is intense, and it requires a massive investment in technology. The alternative is for banks to try and compete head on by building their own digital wallets and stablecoin offerings. Some may succeed, but they're at a huge disadvantage. Their legacy technology and corporate culture make it incredibly difficult to innovate at startup speed. So, the future of banking is a story of transformation, not total annihilation. Some banks will fail, some will be acquired. The survivors will likely become either the invisible utility layer for the fintech world or manage to build a truly compelling digital first offering. The marbled halls and friendly tellers will fade into memory, replaced by server farms and compliance officers. The bank as a place is dying. The bank as a service is being reborn, but in a form so different it might as well be a new institution entirely. We've covered a lot, from the crumbling foundations of the old system to the blueprint for the new one. This is a paradigm shift that will redefine our relationship with money. Staying ahead of this curve isn't just an advantage, it's a necessity. If you got value from this deep dive and want to keep getting insights to help you navigate this revolution, hit that subscribe button and turn on notifications. The financial world is changing faster than ever, and this channel is your guide to staying prepared. The institution that has defined our financial lives is facing a moment of truth. This isn't hype, it's the logical conclusion of a technological disruption as powerful as the one that replaced the horse with the automobile. The cracks are already showing. Thousands of branches are closing, and the technology powering our financial system is slow, expensive, and built for a bygone era. Into this void, a two-pronged revolution is unfolding. First, digital wallets have already captured billions of users, proving that finance can be instant, seamless, and customer-centric. They've eroded the daily relationship that was once the bedrock of banking. The second wave, the stablecoin endgame, is the decisive blow. By putting a digital dollar onto open global networks, stablecoins are making the bank's core infrastructure obsolete. They offer a world of near instant, near free global payments and are the foundation for a new, decentralized financial system. This isn't a distant future. Stablecoin transaction volumes are already rivaling major card networks. Businesses are drawn by massive cost savings, and individuals are being empowered with greater control. Of course, the path forward is filled with hurdles. Regulation is being built, security must be perfected, and trust must be earned. The banks that survive will do so by transforming into the invisible, regulated plumbing that supports this new world. The era of the traditional bank as the center of our financial universe is over. They are facing a fundamental redefinition of their purpose. For centuries, they were the gatekeepers. Now the gates are being thrown open. The question is no longer if your bank will disappear in its current form, but how quickly it will happen and what you will do to prepare. The financial revolution is here. Are you ready?